Good morning, everybody. It is Saturday, July 24th, 2021, and we are going to take a look at the energy transition to clean energy, something that I've been calling the peak oil plateau since 2014. And I thought we should take a look at where we've been and where we are so that we know better where we're going. I'll just put a couple personal notes in here first. In the past week, I've been helping a friend get to radiation and chemotherapy. It's been complicated by some memory issues that he has. We're not sure what's going on there, but we're going to have to look into that next. We're hoping that he's just stressed out, and the cancer treatment has left him with a memory loss, but I've noticed it with him for a couple years, so it's probably something else. So my time here for the next month or so is going to be a little bit limited. I am also going out to Las Vegas because I won tickets in the online World Series of Poker. So I have 2 tournaments to play in that other people are paying for. I get to keep 65% of whatever I win. Hopefully it's not 65% of zero. I do have quite a few things on the agenda here for post Labor Day, and I've got piles and piles of cyber notes to get published. In the meantime, Scott Henderson over at Fundamental Trends has been working on formatting for the swing trading articles. Those seem to be just about where we want them to be, but essentially he wants to answer questions of what he sees, what it means, and what to do about it. On the swing trading front, I don't do a lot of swing trading. I'll pick out 1 or 2 trades a month. He's picking out 2 or 3 a week. So for those of you who want to do swing trading, Fundamental Trends is the place to be for that. There will be a handful of catalyst-driven, fundamentally driven swing trades over at Margin of Safety, and those will generally be wrapped around earnings and things like that. Over here at the peak oil plateau, you have seen that I have introduced a couple of companies in energy over the last several years. Enphase, SunPower. There's a carbon capture company that I just added to our very short list. I'll be interviewing that CEO in about 3 weeks. I've already talked to him, and we will be interviewing him right after the earnings announcements that they make, I believe, on August 15th. So if you're a subscriber, you'll see an update to the VSL before I leave to Vegas. And the company I'm talking about is actually on the plug and play. So on our shorter, very short list, our focus list, our VSL, our very short list, of course, is our galaxy, about 200 companies that we keep track of that we think have screened well, and now we're digging deeper into them. And it looks like they have potential for doubles or triples if they're dividend stocks, and better than triples if they're growth stocks over the next several years. In 2014, in June, I wrote an article on MarketWatch. And in that article, I talked about how oil price was going to fall dramatically. And I got mocked for it. And I repeated what I said in a July article. And essentially what I said, and at the time, price of oil was around $100 a barrel. I said that the price of oil would drop to the low end of the range, which was 60s and 70s. And I was told that that would never happen because they controlled the oil market so well that it could never get loose enough to see price of oil fall. Well, the problem with that is that that narrative comes from people who think that oil is only cyclical and that oil demand was going to be perpetually going higher, or at least going higher for decades and decades. By 2014, we started to realize that that wasn't really true. What we saw is that oil demand had really stopped going up in any meaningful way. 500,000, maybe 1 million barrels a day per year, which amounted to 0.5% or 1% growth. That's not a very high growth rate for companies that are sinking a lot of money into oil production. In particular, at the time, there was a big boom in mega projects going on in the deep sea. You had the Canadian oil sands ramped up, and you had the shale boom in full swing. What we have learned in those last 7 years is that Canadian oil sands, even though once they're developed, are pretty cheap to operate, they're super expensive to get started, and the environmental destruction was so off the charts that the environmental opposition to wiping out forests, which is really what the Canadian oil sands were doing, was wiping out forests, came to a peak, and that had to stop. The deep water drilling was peaking, and the money that was flowing into shale was really off the charts. So you had this supply boom from North America, really. They hadn't been there. And simultaneously, you had demand for oil really having no growth rate at all anymore. So those people who chant, well, oil is cyclical, when it goes up, it'll come down, but then it'll go back up, didn't really tell the truth. And that's when it started to rise. On the idea that there was going to be peak oil supply, and that the market for oil was going to be characterized by rising demand in the face of falling supply. And it became pretty apparent to me in 2014 that was wrong. It also became apparent to me that solar and batteries and a shift towards EVs was inevitable. And while the EVs were in a very early stage at that point, the idea that hybrid vehicles would be out there should have made anybody sit up and listen. Because what that meant is that if nothing else, the efficiency of cars was going to go through the roof, even if they were still using gasoline or diesel. And that mileage per gallon was going to go up dramatically. And in fact, from 2014 to 2026, miles per gallon is roughly going to have doubled. And we aren't seeing anything like a doubling of the number of drivers. And now with COVID-19 and a shift towards work from home that is going to at least partially last forever, there's going to be lots of hybrid working. People like me may stay working at home forever. I flirt with opening an office again because the office space is so cheap. But at the same time, I really don't want to go back to driving to work if I don't have to. I might just buy a showier house on water or with a mountain view or something that I can invite people over to on the rare occasion that I see people face to face anymore. And that's a lot of people in finance. It's a lot of people who work in internet or IoT related industries. Is that most of us, and it's 20-25% of the population at this point, have the ability to work from home or remotely at least most of the time. And all these things were already coming before COVID, and then COVID accelerated it. So when we look back over the last 7 years for oil, what we see is that the shift started slowly, that COVID accelerated it. So I had projected a deep decline in oil prices in 2014, which occurred several months later. The rebound was weak as expected. And since then, there's been 3 waves of oil company bankruptcies that have happened since 2014. The latest bankruptcy wave was, of course, spurred by COVID. Then 2 things happened. The Federal Reserve bailed out the oil companies by extending debt and providing liquidity. And Saudi Arabia has led a rebalancing of the oil markets that has driven the price of oil back up to about $80 a barrel. This is something that I thought they could have accomplished 3 or 4 years ago, and I was wrong. It took COVID wiping out more companies for them to successfully rebalance the oil market. But what should that tell you? That should tell you that the supply and demand dynamics for oil have permanently changed. That what we're seeing now from COVID in oil is just a rebound. I would caution anybody from falling into the fake bullish narratives about oil and its future, because if you do, you're going to lose a lot of money. Because one day soon, and I don't know if it's this year, next year, year after, but one day soon, without a lot of warning, the price of oil is going to fall off a cliff again, like it did in 2014, like it did in 2020. So my general thesis on oil has been unchanged since December of 2014. Oil demand will remain in the 95 to 105 million barrels per day of demand for an extended period. This is what I'm calling the peak oil plateau. And it's happening because automobile efficiency improved. Then feedstocks for petrochemicals are finding substitutes. And that company that I added to the plug and play is one of the companies that's popping up. Took 7 years. They've been around. There's actually bigger companies. But now what we're starting to see is carbon capture and carbon sequestering in ways that make the round trip for the fossil fuel almost carbon neutral. And the company that I've showed you can actually mathematically create a negative carbon impact, meaning that the carbon going into the fuel system that they're a part of is lower than what they're pulling out. Remember that company, New Light Technology, that I've talked about for several years, that if I could ever get in on them, I would. I was hoping a SPAC would take them public, and I haven't seen it yet. They pull carbon out of water treatment plants, dairy farms, power plants, and they turn it into a feedstock, plastics. Really turns carbon dioxide and methane into plastic by pulling carbon out of the air. The company that I just introduced to you pulls carbon out of the air. They're doing it at dairy farms in California. So where are we moving towards? The ship has almost turned in the fossil fuel market. About 5 more years, it'll be all the way turned. And then the acceleration to clean energy is going to blow people's minds. Because once the ship is turned, I've told you 2026 is the year that it's going to happen for a bunch of legal reasons and technology reasons hitting each other. And this all stems from this original thesis that any short-term oil demand increases can easily be met by existing supply capacity, consider Saudi Arabia's excess capacity, and then most of OPEC's desire to pump and sell more before the oil age is over. Long-term oil demand is set to plummet in the 2030s when this ship is turned and has been turned for 4 or 5 years. So during the 2020s, we're on this intermediate term plateau with basically stable demand. You know, we're rebounding right now, but then the curve's already turning over, right? The rebound curve that went straight up the last several months has already started to curve back over to the right to be more level again. By the end of the decade, you're going to probably see the very first signs of oil demand falling. 1 million barrels a day, 2 million barrels a day, not much, but closer to that 95 million barrels a day of demand by 2030 than the 105 probably. So I also said in the short run, we'll see many companies go bankrupt. I suggested, and this is exact quote, if it's in italics, I haven't changed that from the original slide. That a third of the industry would go bankrupt. And I also said that people financing shale would eventually demand that it makes sense economically. And I suggested that the oil supply and demand would rebalance by about 2017. Again, I was wrong on that. It took COVID-19 in 2020 to lead to that rebalance. So I got a couple things wrong there. Rebalancing of the oil market did not occur by 2017, it took until 2020. And it wasn't 1/3 of the US oil industry that went bankrupt or had to merge with another company and then shut down production. It was half. And in fact, it's closer to 60%. So we've seen over half of the US oil producers disappear in the last 7 years. We've seen a lot of charts that look like this one, Transocean. I'm just popping this chart up because it was brought to my attention that about 4 years ago, I said that Transocean would never rebound. And somebody caught a point that day rates on these ships have finally got back over a certain level. It was really, again, because of COVID. I think the original article I wrote on Transocean was right about here. I'd have to look it up. And everybody thought that was going to break out. I said, no, it's probably going to make a run at bankruptcy, go single digits. I said Seadrill would go bankrupt. Seadrill, in fact, did go bankrupt. And I'm not sure if Transocean got under a buck. Looks like it did. And it's rebounded. And again, it's been a 10 bagger for a lot of people who bought it right at the bottom. But the idea that this is somehow a bullish chart, I think, is pretty funny. Backlogs for Transocean have consistently shrunk, even though day rates have gone up. And that's because they've scrapped over half of their fleet. And it's funny to me that they buy back shares in the face of still what is very massive debt that will take them 20 to 30 years to pay off, which means they're never really going to give money back to shareholders. They're just going to pay off their debt. So you have traders trading Transocean, just like they're trading all sorts of other oil stocks. Again, does this look like a bullish chart? Looks to me like it has been cyclical with a bullish trend up until 2014. Has been a bit cyclical, weirdly cyclical. The bearish trend since 2014. This is the XLE Spider Select Energy. And we can look at XOP, oil and gas exploration. Again, same thing, cyclical with a bullish trend. And there's a newer fund here, so financial crisis. Take it from here to here, bullish trend, here to here, since 2014, bearish trend. So you get a rebound off the COVID bottom. What do you think happens next? Well, maybe it doesn't plunge all the way down here, but I think it will. I actually think that this fund is going to be closed. It's going to be merged into XLE at some point. Why? There's just not enough companies left. Again, from 2014, this is all original. So the most cost-efficient U.S. shale is the Permian Basin. To the extent I want to invest in a few oil companies, I'll look there first. You know that Pioneer Resources is the only U.S. independent oil company that I'll consider investing in. It's the only one. It's 100% Permian, and they've got the best balance sheet. If they can't do it, no one can. Rah-rah-ree. I was neutral on Bakken and Stack Scoop to negative on everything else for other oil plays in America. And at this point, I'm negative on the Stack Scoop. Still neutral on the Bakken. I am interested in one international oil major. You all know who it is. They've changed their name a bit, but it's Total. Now they're Total Energy. Oil pipelines, I said, would face continuous pressure from environmentalists, which would make it difficult to maintain capacity over time. And their balance sheets are loaded with more debt than future growth will ever pay down, especially if volumes fall, which they will. The natural gas pipelines, I pointed out, offer some bridge to the future and a backdoor play on carbon capture and hydrogen. So we've picked out the best company that fits this idea, which is Kinder Morgan. We've made a ton in dividends. We're probably up 20, 30% on it by now. Not super sexy, but if it ends up being one of the last men standing, as the oil pipelines with their associated natural gas capacity start to shrink, still think Kinder Morgan can get back to 30. But for my retired clients, it is a pretty darn good way to collect a fat 6-7% dividend and get a general slow path upward in price. So a total return that I think will approach a double over the next 6, 7, 8 years. I also said this: geopolitical issues are important to be aware of, and there's nothing on here that I really had wrong. Russia and Iran needed higher oil production. Iran's still trying to get it. Russia does what they want. Saudi Arabia and the Gulf Cooperation Councils need higher oil prices. Again, this is from back in 2014. And I thought that they'd have it rebalanced by 2017 as they forced out the ultra deep water oil sands. And I thought shale would shrink and be the marginal producer. You've paid attention to what the Saudi Arabians have been saying for a couple of years now. They're basically telling everybody, no, shale will not be the marginal producer. We will be. So shale needs to find a flat line. And that's what's been happening. Very little uptick in oil production in the U.S. A little bit lately, but not much. Back then, the U.S. had just lifted their oil export restrictions. I wouldn't be surprised to see those restrictions come back in the next 3.5 years. So I said it would be unlikely those major national producers, Saudi Arabia, Iran, whatnot, would stand for oil prices to remain below $70 for much longer. And again, I was anticipating a rebound to 70-ish, maybe 80. I said 80 a number of times by 2017. But again, even I, who was bullish on the uptake of clean energy, underestimated how big of a shift in supply and demand dynamics there were. Demand just isn't going up really at all in oil. And there's so much supply available in this run out period that it's going to be difficult for them to keep the price of oil high. And if they do, all that does is create a situation where people adopt EVs even faster. I had also talked about the potential for war in the Middle East. I'm actually fairly surprised that the war in the Middle East haven't gotten worse. They're just the typical shoot at you once in a while, launch a missile at you once in a while sorts of things have been going on for, since there was missiles and guns, I guess. So at this point, I don't really know how to handicap potential war in the Middle East, but I do know this. If oil prices do trade above $80 per barrel for whatever reason, that will spur even faster adoption of EVs, which decreases oil demand, which would in turn unleash another wave of bankruptcies in U.S. oil companies in particular. So it's really a truly a lose-lose situation for U.S. oil companies in most cases. Any company with a leveraged balance sheet really doesn't have a good outlook. Prices go up, demand goes down. Price goes down, just destroys their current profits. So again, this was my investment thesis at the time based on what I expected to play out. And again, everything that's happened in the last 7 years in energy has proved that the ship is turning faster and that the supply and demand equation essentially flipped in 2014. That was the flip. That was the beginning of the end of the oil age, which was the title of one of my articles. But we're 7 years into the end of the oil age. And how long will that last? It'll last decades. But you need to consider at what point does it just become a completely unviable investment for anybody other than, maybe an executive or somebody that owns a couple of wells on their land. The future of oil is bleak as coal. And you can take it to the bank that legislation is coming, and many corporations are already just imposing their will. You can take it to the bank that legislation on climate change and the environment in general is going to become more draconian towards fossil fuels this decade. It has to. Anybody who doesn't believe that climate change is a big deal is basically telling the Pentagon that they're wrong. The crossed wires, the mixed messages, the ideological imperatives, the hypocrisy of contradictions is off the charts among the people who argue that climate change isn't real and that oil is forever. Because it flies straight in the face of the very people that they say that they believe in and that they're on the side of. If you're anti-climate change, you're telling the Pentagon, essentially every science agency, and most independent analysts, big and small, that they're wrong. And I can categorically tell you something, please bet against me. Please buy some more oil stocks here at the end of this rally. Please be the greater fool. But remember, although everything I said has been right so far, sometimes I've been a bit early, which in investing means you're wrong. So how do you mitigate that risk of the timing? Well, the first thing you can do is just know the facts, and then be a long investor in the things that have a brighter secular uptrend. You can be a long-only position trader. So for you as an investor, you need to consider what you are. And again, I bring this up because I saw in the chat room this week, somebody seemed to be a little bit confused. They were using swing trading signals to establish position trades, and that's not how that works. Short-term signals are based on short-term charts for short-term moves. If you're a position trader, you need to use weekly charts to see what the longer term, which is what position trades are defined as, longer term, over a year, generally full cycle, so 2 to 10 years, have to say. So a weekly chart is telling you a longer term trend. A daily or 4-hour or 1-hour chart, yeah, that's telling you what could happen in the next couple of weeks or months. If you get all the way down to the minute charts and second charts, you're a day trader and you're working way too hard, because you don't need to day trade if you mostly are long only position trading and you make a handful of swing trades. That's where the biggest money is. The biggest money, as one of the 10 richest people in the world has said, is made in waiting and being patient. So hyperactive traders, while they can be hot for a year or two, and if you can get rich fast enough and then take your chips off the table and remember not to bet it all on green, then the old adage, you only have to get rich once, applies. But most people who run up their accounts get so into their results for the short term, they start over trading at a time when things aren't going their way, and they give a lot of it back. Why? Because they break their own rules. So swing trading is all about mindset and discipline, much like a game that I'm going to play in Vegas. Because almost everybody has the technical skills to be a trader who's doing it. Just like most poker players today have very similar skills. And it comes down to patience and the ability to read. In the case of investing, it's the market. In the case of poker, it's the other players. So when I see something like oil companies buying back shares, I laugh, because all they're doing is using this run-up to skim money out to the executives through the buybacks. That's how that works. Even though they have debts, they're probably never going to get paid back. It's a scam. It's a skim. It's a bullshit. There's maybe one U.S. oil company that I think can buy back shares, and that's Pioneer. There's not another one out there that's healthy enough financially in the face of the end of the oil age to do it. We're finally starting to see Exxon make some changes, but only because activists had to come in there and essentially put the executives on notice that you have to stop skimming money out of this company, because otherwise it won't survive. So those activists are going to get blamed for the fall in the share price, but really they should get credit for saving the company, because that's probably what's going to happen, is they'll save the company, but it's going to shrink. Exxon, on the path that the executives had laid out before the activists came in my opinion, was headed towards bankruptcy. Not like disappear forever bankruptcy, but wipe out the shareholders and recapitalize, making the bondholders the new shareholders type of bankruptcy. And I think they're going to avoid that now, because the activists have came in and said, look, stop stealing money from this company and do what you need to do. And management suddenly had the epiphany to get rid of a third of their workforce that was redundant and unnecessary, and essentially wipe out their deep sea exploration program that I've been saying they should have done for 7 years. Ship is turning faster than most people think. There's going to be another wave of oil stock collapses. It's going to happen soon. Oil pipeline companies aren't anywhere near as strong as people think because they can't replace their pipelines. They can't increase capacity. And even if they can get a project built, it's dead sunken money that's never going to pay off because oil demand is just starting to fall. First growth rate slowed. Now we got this weird rebound because of COVID, but the secular changes have become even more pronounced because of COVID. So don't buy the hype. Don't be the greater fool. Don't put your mouth on the tailpipe of the fake narratives that are out there about oil. We are in the end of the oil age, maybe the second inning. And it'll take until the 6th or 7th inning for most people to figure it out. Between now and then, there is literally millions of dollars to be made, primarily as a long investor in clean energy. And you can try to add some home run, grand slam potential, some well-placed short bets. But I would say your better thing to do is simply buy a little bit more of your long-term long positions before certain events, like earnings, and juice your portfolio on the long side. You don't even have to use options, I don't think, but you can. You can do synthetic longs, which would be sell a put to collect a premium, and then use that premium to buy some calls. Worst case scenario, you end up a little bit more of stock that you liked anyway. And if there's a rally because you picked the right catalyst, period, earnings period, usually again, you might turn a dime into $1 on some of these options. Again, short-term calls. Don't ask me about leaps because the calendar works against you. It is stupid to pay out big premiums on calls. You buy short-term calls when the premiums are low because you know something that the market doesn't. And understand that half the time you're going to lose. Probably 60% of the time you're going to lose. Because sometimes the market doesn't cooperate. And really, usually the market doesn't cooperate. But every now and then, the dime turns into $1 or $2. Well, I would tell most of you just to be long only, long-term investors, position traders. I know that some of you want to do sexier things. And that's why I brought in the sexy Scott Henderson, who's got a ridiculous track record. It comes with a very high recommendation. So I'm going to finish this report over the next month or so, and I'm going to put in 10 companies, maybe 20, that I think are potentially going to do what Transocean did and go almost to zero, maybe 2-0. I think there's a lot of oil stocks that are going to go to zero. And because that'll get me headline attention, I'll probably put that in a couple headlines. XYZ company could go to zero by 2030. That's not really where the big money is going to be made. The biggest money is going to be made in buying a $10, $20, $30 stock today that's worth 100, 200, 300 by 2030. Those small caps and mid caps have taken it on the chin lately. A little bit of rebound in mid caps. There is a lot of opportunity in these smaller companies in the mid space. And it's not just energy companies. You know, we've got those 4 satellite as a service stocks. One of those is going to be a 10-bagger. I don't know which one. And the other ones will be okay. Maybe all 4 of them will be 10-baggers. I don't know. But between the energy transition and AI, IoT, and 5G and space and biotech, there are some gigantic winners out there. So don't get sucked into fake news, fake narratives, mean narratives, untrue narratives about oil is going to be forever, or this capital intensive business can go to the moon. Generally doesn't work that way. We want companies that are less capital intensive because they can scale faster and have bigger margins, recurring revenues without massively increasing inputs. Think of investing like a business person. Think of it like me and my business. As an investment advisor, I made pretty good money. Still do, but I don't chase that business. If you're not a reader of mine, you probably don't know I exist because I don't try to exist anywhere else other than one of my research makes me exist. I know that at an average of $300 a head after discounts, my income can just keep going up as I write, and it doesn't cost me anything to write for 1,000 people versus 10,000 people. No change in input, but revenue goes up. Those are the models that we're looking for, where inputs don't go up a lot, but revenues can. Expect a lot more on energy, because the clean energy investments are pretty exciting. And now that I've done the primary research on carbon capture, I think I got a couple more ideas. But I'm still going through the vetting process. Kinder Morgan, that's one that I'll mention here. Biggest transporter of CO2. They just went into it even more. Pulling carbon out of the air is going to be a big business. And it's not going to be like, you're just going to go down the street and say, oh, look, there's a carbon sucker. No, it's going to be you drive in the country and you see that the dairy farm has some sort of a setup to capture all the cow farts. It's what it is. Or the water filtration plant, or the natural gas power plant. The big emitters are going to start doing carbon capture. And there are certain companies that have a road into that. And they're more capital intensive than I want. So I'm not going to hold them forever, but they're all underappreciated right now. So they're going to close the gap between undervalued and fair valued. And then I'll probably get out. Some of these other companies, they have more recurring types of revenues once they have their build out done. Some of the software as a service companies in clean energy, pretty interesting. So if that industry goes up 50-fold in the next 20 years, which it probably will, the software as a service companies and the companies that collect a toll are going to be pretty fat. All right. Have a wonderful weekend. Stay cool if you're somewhere steaming hot.